Welcome to Naturally Bay Area Quick Bites, a panel discussion on food venture financing in the new normal, trends in 2021. We have an excellent panel to discuss this topic with you today. They'll introduce themselves in a minute. Quickly about the format for this program, we're going to be having a conversation for about 35 minutes among the panelists on topics looking back into 2020, looking at a snapshot of what's happened in the first half of this year, and then doing some thinking about what we expect to happen in the second half of this year in the food venture financing sector. We'll ask you to post your questions in the Q&A function, not the chat function. And we'll be getting to that, as I say, at about 12:35, and we'll wrap this up at 12:45. So with that, I'd like to welcome our panelists, Karen, Mira, and Rodney, and I would ask each of you to introduce yourselves, tell us a little bit about your firms for the first several minutes. Karen, you want to start?
Of course, thanks, Don. I'm Karen Howland. I'm a managing director at Circle Up. Circle Up is an investment platform which invests in early stage consumer brands on both the equity and the debt side of things. I work in the equity business, which focuses really on fast turning consumable products like food, beverage, personal care, beauty, pet, and household consumables. We use an internally developed data platform called Helio to help inform investment decisions and to help our entrepreneurs after we've partnered with them. We tend to look for innovation and brands that are meeting the consumers' growing and evolving needs, which obviously is continues to change at rapid pace.
Thanks, Karen. Mira, could you tell us a little bit about yourself and Propeller Industries?
Hi, yeah, my name is Mira. I'm with Propeller Industries. So we provide strategic finance and accounting services for about 300 early stage venture-backed companies. When we say early stage companies, as low as 1 million in revenue up to about 50 million in revenue. And I'm actually part of the transaction advisory team. So we carved out that practice area about a year ago. There's a couple of us who are ex-bankers, operators, work in private equity, things like that. And we just love raising money for our companies and know the early stage VC network really well. And so I spend 75% of my time running full-scale private placement processes for existing clients or for VC's portfolio companies. And we spend the other 25% of our time working on M&A and strategic analyses.
Thanks, Mira. And Rodney?
Hi, I'm Rodney Clark. I'm a co-founder and managing partner at Aspect Consumer Partners. We are a strategic M&A and corporate finance advisory firm. We're a boutique, a small boutique, but we punch well above our weight class. We love working with brands, and we're focused around a pretty simple concept, which is giving the right advice to companies, owners, entrepreneurs, and business builders. I've been doing this about 30 years. The rest of our team has been doing it at least 10 to 20 years. We love what we do. We have been fortunate enough to work with some really neat brands, and happy to be here today and share whatever we can from some of the transactions and learnings we've had being in the market that long.
Thanks, Rodney. So what we have on the panel are three very different and very experienced perspectives. One from the investor side, with Circle Up and Karen's viewpoint into that. They actually invest in early stage brands. Mira and Propeller Industries advise early stage and emerging brands on how to get ready for financing events, and they support them in that process. And Rodney and Aspect Consumer do the investment banking, where they work with companies and help find capital for them, as well as exit transactions when they're ready to exit their business. So three excellent perspectives and excellent skill sets here. Let's start with a look back into 2020. And Karen, could you start the conversation with your views about how the pandemic affected food venture financing in 2020?
Yeah, I mean, 2020 was a whirlwind, right? I mean, if you think back, I mean, COVID really hit and started coming to the United States in a large manner right when Expo West was happening, right? And Expo West ended up getting canceled. I remember the week before, everyone, should we go? Should we not? Should we cancel? Should we not? Expo West is obviously a great opportunity to go out and meet buyers. but it's also a really important opportunity for a lot of these early stage companies to meet with investors and meet with different financing options as well. There's a lot of that goes on at that event as well, which just came to a screeching halt, right? Because the event was canceled. I think the first, call it 2 months or so post COVID really hitting in that March, April time period, there wasn't a lot going on. A lot of people were very focused on, what is happening with our existing portfolio? How do I work with them to make sure their balance sheet is secure? How do we think about the fact how long this could play out, what it could mean as far as consumer demand? So really focused on existing portfolios rather than going out and making a lot of additional investments. I think in the summertime period, all of a sudden that shifted a little bit, where the investors are actually starting to get hungry to actually make investments, realizing, okay, we've got to adjust to this new norm. There are still amazing brands out there. There's still innovation happening. Let's figure out places where we could put capital to work. But that was right when the PPP loans were hitting. And a lot of people went out and applied for PPP loans, which were well-deserved and obviously was a big benefit for a lot of companies. And so people were able to postpone fundraising as well a little bit longer on the back of that. We really saw things begin to take off in a pretty material way, kind of towards the back end of the year and into 2021. But there certainly was a time period where things were pretty darn quiet as people were trying to get used to the new norm.
Thanks, Karen. And Rodney and Mira, do you have views looking back?
Yeah, I might add, our viewpoint is similar to what Karen had said. And really what we saw as the turning point in the market the venture world is down in the early stage of the corporate life cycle. You look sometimes to see where confidence is in the market, in the business environment, the business cycle in the later stages. And there started to be a lot of strategic M&A activity at robust multiples and sizable transactions. So the remaining part of Kind got bought. Kind itself made an acquisition. McCormick, I think, bought Cholula. And there was another business that McCormick bought, which was, they paid $1.5 billion in total within a couple of months of time. And that really started to tell people, hey, the markets are open, confidence is up, and for good brands that have good traction, there's a market there to do transactions. So it's pretty neat, and we've just continued to see that into 2021.
Any thoughts, Mira, looking back?
I kind of totally agree with what Karen said. We saw a halt to all investing activity from March to September. But like Karen said, good companies were growing. There's kind of a bifurcation. I think a lot of companies that had more of a retail exposure were getting really hurt, while companies with a lot of DTC exposure were actually taking off last year, and investors had a lot of money to deploy. And so I think around September, we started to see a ton of financing activity. And I think last quarter was actually busier for us than first quarter of this year because of that.
Terrific. And, I think our sector generally, and certainly healthy, better for you foods, did well through the pandemic, just as norm, even though the financing activity didn't start kicking back in until maybe Q4 of last year. Let's take a snapshot of this year so far, year to date. What are we seeing so far in the first 5 months of this year that we maybe didn't see even at the end of last year in food venture financing? Mary, you want to kick off that?
Yeah, I think what we're seeing actually is, so again, fourth quarter of last year, a ton of deal activity, a lot of financings going against really amazing revenue trajectory. What I've noticed earlier this year is some of those companies now are facing some headwinds, those D2C companies. CACs are coming up. Investors are a little apprehensive about what the underlying revenue profile of the company is. So I almost think the last couple of months have been harder for companies that did really well in COVID, because now investors are seeing things come in slightly softer and there's more scrutiny. That's what we're seeing a lot of. I mean, they're still great companies. They still have a great profile, but I think they were getting valued off of 2021 numbers that now are coming in slightly lower than expected. That's something we're seeing. And I know you asked about food, but I will tell you just anecdotally, we're seeing a lot of interest in beauty, health and wellness, and personal care, because I think what came out of the pandemic were two major things: focus on omni-channel, but also a focus on taking care of yourself. And so I think better for you products and companies are actually really taking off right now.
Karen or Rodney, anything to add to that?
Yeah, I would really echo Mira's comments as far as the scrutiny around the numbers. And I think it's in part because there obviously was a material shift towards online shopping that happened last year. I think a lot of us are scratching our heads and saying, okay, did it go from 5% of consumption to 20% and now it's going to level back out at 15, or is 20% that new norm? And how do we think about that going forward? We speak to a lot of businesses that, the trajectory of the business was growing nicely. And then all of a sudden during the COVID period, whether it be at the retail channel or direct to consumer, really spiked for kind of 4 or 5 months and then leveled back out. And you're seeing forecasts and models that show that growth is going to continue this upcoming summer, which very well might, and lots of companies it might. However, I think we are certainly taking a bit of a more cautious lens of like, okay, any companies businesses that saw massive spikes in June, July, or May, June, July, as like food shortages were going on, out of stock was going on, it's unlikely to repeat. Just like those companies that sell into Sephora, where all the Sephora doors were closed last year, we kind of look through that period as well to try to kind of get to a more normalized level. But I think there is a lot of that uncertainty around as we're cycling through what happened last year. What does that mean for this year? And what is that normal trajectory of the business going forward?
Yeah, Karen makes a great point. So we've been out in the market with a number of deals over the past 3 to 6 months. And what we've seen is investor skepticism on that kind of big rise in results that happened this past year. And the challenge has been, and this is where companies should spend some time if they're going to go out into the market and talk to people, spend time on what Karen had mentioned. What is a normalized run rate for your business, X the effect of COVID, that you can back up through the data and what your customers are saying? And that's what investors will tend to underwrite to. We've actually had people in some interesting feedback from the market. People come back to us on transactions and say, well, we can't value this off 2020 results or get even close. So our valuation's off 2019 with some growth factor that's a random growth factor, by the way, but some growth factor that we feel comfortable with. And companies, of course, want the valuation and the full results if they did get a spike in 2020, say. So it is a bit of a challenge. We've also had other people just bow out of processes and say, hey, we see there's a huge run up and a huge spike in 2020 results. The company's probably looking for valuation off those results. We just can't get comfortable with that and don't know how we could get comfortable on the go forward basis with the data. So we're going to pull out of the process. So it's a pretty interesting time, although we do see the dialogue is extremely heavy, and think in probably the next 3 to 6 months, we are going to see just a ton of different deals being announced, M&A deals, financings, because there's a lot of deals out in the market and a lot of people looking at them.
So let's look now at the micro sectors within or categories within food and beverage and personal care that seem to have been getting the most attention from the investor community in the last 6 months and maybe the last 18 months as we go back to the beginning of the pandemic. Rodney, do you want to take a first crack at that?
Yeah, I mean, I would say what's attractive, so actually let's abstract for a minute. So we've been on a journey in the deal world, financings and M&A, to a better and more sustainable food system for some time. COVID obviously took us off the track that we were on, but the interest level that we've seen has come back and come back strong. As we were preparing for these this call, Dawn, I was trying to look through some of the data and say, well, what are the sectors that have really emerged? And I would honestly say we have seen activity just like it's been at all levels of the kind of healthy, sustainable food and beverage market. And there's not really a stop to it. So whether that's packaging, which has emerged as an interesting area, or manufacturing or distribution, retail even, we've really seen a focus across all of those areas, looking for companies that are strong companies with a good revenue growth profile and good profitability. So I can't really point to one or any other area. I would say the food tech area still is enjoying larger, higher, bigger valuations off financials that may or may not warrant those still. There still seems to be a disconnect there. But all sectors are pretty much firing on all cylinders right now, as far as we see in the dialogue.
Mira, Karen, any sense of product categories that seem to be white hot or attracting attention now?
It feels like every time you turn around, there's a RTD alc beverage company that's launching. And we're seeing a ton of interest in that space. It's still a relatively underpenetrated space as far as in the spirit side of things. And obviously everyone saw what happened with White Claw and Truly and the massive acceleration there. I think this isn't a category necessarily, but I think a lot of people are trying to get their heads around, like, we all knew Amazon is growing and is becoming a more important partner for the longer period, but how to really underwrite the changes that are going on in that dynamic. Like the bar category is a perfect example, right? Bar category in retail has been slowly declining for the last several years and saw a really big hit this past year, but the bar category in Amazon and the multi-packs is growing really nicely. And we have seen several businesses that have launched primarily more omni-channel and away, or omni-channel being direct to consumer and Amazon, that have had a lot of success. And so I think that idea around how to think about brands that are Amazon, not necessarily Amazon first, but like heavier in the Amazon channel, is one that we are certainly paying a lot of attention to. And Rodney, I'll probably call you later on to pick your brain just to see what your views are. If strategics value that piece of the business as much as they do the traditional retail side of things.
Great point. They absolutely do. Sorry to cut you off, Mira. But so people on this call or on the broader call may recall, Costco and the club channel used to be ugly and dirty, and you can't build your brand there, and you can't start there with your brand. And if you have significant exposure to that, or mass market or drug channel, we would say that that's Amazon. People are looking into that and liking that revenue. And it's valid. What's interesting and very good about it is you get a lot of robust data off it on competitors, competitive brands, and your own brand and velocities. And that's what everybody's looking for, to see, is your brand really resonating with the customer?
Yeah, and I think the only thing I would add is, I said a little earlier, in terms of sector that's really coming out, I think the health and wellness, beauty, skincare, taking care of yourself, getting more attraction than food and bev on our end. But I don't really see it in terms of sectors. I think what we're seeing is companies that have a very clear path to profitability, no matter what space they are in. If investors can get comfortable that there's a long-term EBITDA profile, I think that's something they're very concerned about. And I think second is the omni-channel presence, and specifically a subscription component to the business, because that's recurring revenue, kind of like a SaaS company. And I think people are willing to put a higher multiple on that kind of a revenue than, brick and mortar one-off purchases.
I think that's right, Mira. That idea around subscription is so long as it is what I would argue, like a true subscription, right? Like I think about nutritional supplements, right? Like that is a daily habitual thing. Coffee, daily habitual thing. We have seen a lot of companies, RTD cocktails, that will put out a subscription model, and you're like, does this really lend itself to a subscription model? And I think that idea of like, does your subscription is great. It is time, it is energy, it is a different relationship with your consumer. Does your category really lend itself to that model? or is a more ad hoc purchase more appropriate? But yeah, I would agree as far as the value of the subscription.
And I would
model,
agree
for
with
sure.
you, Karen. I think what investors, when they really dig into the data room and are trying to understand the financials, they're going into the cohort data and trying to understand the true recurring revenue and repeat purchase behavior. So, yeah.
So my next question is the size of companies in terms of revenue levels that are attracting capital in this market. You know, where's the sweet spot in terms of size of companies that are finding it easier to raise capital in your experience? And Karen, do you want to start the conversation on that?
Yeah, I don't. So we invest in businesses that are between 1 and 20 million of LTM sales. If I look at the number of companies that we've looked at, and I pulled this information earlier today, it feels like there are companies that are extraordinarily competitive in that $1 million range. There are companies that are extraordinarily competitive in that 5, in that 10, in that 15. And so I don't think there is necessarily a lack of interest in any of the categories. Where that interest is coming from is very different. We've seen kind of like in that $1 to $2 million range as far as revenue, or in a little and below that, presumably, it tends to be very focused on friends and family and high net worth individuals, which obviously is a great channel. But then you have to think about what kind of value add do they provide over the longer term. Is it anything more than a check? Which, by the way, sometimes that's all you need, and that is absolutely perfect. But kind of thinking about the strategic value that comes with that check. Whereas, you know, north of that $5 million range, there seems to be a lot of institutional interest. I would say the one difference, though, is really on the beauty side. We're seeing a lot of institutional interest, even in that, call it $1 to $3 million range.
And just so I could clarify, when you say institutional interest, are those PE firms that you're referring to?
Yeah, venture capital funds, right? So like the Circle Ups of the world, the Imaginaries of the world, the Cults Capitals of the world, the institutional money, but very focused on the early stage side of things.
Right. Mira, Rodney, any views on that?
I completely agree with Karen. So, yeah. I would actually say maybe even a little bit higher. We're seeing it. I used to feel like sub 3, but I actually feel like it's trying to get VC interest right now. People are all going up market. And so I think even the smaller VC funds, I used to kind of look at, companies with 2 million run rate. Now they're sort of at 5 million. So I think, like Karen said, the friends and family is sort of what we're seeing at that stage.
Send them our way if you see any. If you see any that are in that $1 to $5 million range.
Yeah, and we'd say there's still strong interest all along sizes. I guess the lens with which investors evaluate deals has changed a bit, and that means they're more concerned with profitability, gross margin, and pushing their bar up a little bit. They'll still look at the smaller businesses, but they have to be perhaps healthier or stronger or giving off more signs at an earlier stage than they did previously.
So let's turn our attention to companies on the earlier end of that continuum, companies that maybe not quite at $1 million sales, but maybe $1 million plus or minus. That historically has been a difficult size category in which to raise capital. How do companies who are in that range start thinking about approaching the market? Where are the opportunities today? What are the challenges in this business environment? Let's talk to our audience who are in that size range and what they should be thinking about. Rodney, you want to start with that? I'm sorry, I think that's Mira's question.
Yeah, and I don't want to come off negative, so I don't think this is just being realistic. I think it's really hard to raise money when you're early, right? And a lot of us have been operators, we've been in that position. I feel like a lot of the early stage funds that used to come in early meaning 2 million revenue run rate, like I said earlier, are climbing up market, and now it's more like a 5 million. I have a fund I was very close to that used to look at 3 million run rate. Now she came back to me and they want 10 million run rate. So what we're advising our clients, and we do bring on at Propeller a lot of early stage companies, is find people who love you, who have passion for what you're doing, and really just are investing in the entrepreneur. And we still advise companies to do a small friends and family round to get them a couple months of traction and data, so that they can go out to market in 6 months at a number that you can get actual institutional capital. And we've had some really phenomenal companies, very on trend, great data for 3 months, but they're so early. Really, this one company I can think of specifically, these 2 female GSB entrepreneurs, just phenomenal. We went out for a couple months, and ultimately, despite their network, despite them being great, ended up cobbling together a friends and family round. Then 6 months later, we're able to go out and get VC funding. And so I typically advise people, don't really even try unless you think you have something that's just completely off the charts.
It always makes me cringe a little bit. And I think you're absolutely right, Mira, but like that idea of like friends and family. And I'm not an entrepreneur. I'm an investor. So, but like, I couldn't think of friends and family to go raise a $500,000 round. Like who has friends and family like that? And I always feel for the the entrepreneurs when they hear time and time again, like, oh, go to friends and family, go to friends and family. I think you're absolutely right. I think that likely is the avenue that is the most logical avenue to go to. But it does always make me cringe a little bit when I think about if I was trying to do it myself, if I actually could find the friends and family to give me that money. I will say, in a personal plug for Circle Up, we're actually launching a fund this upcoming fall that is going to be focused on companies that are between $500,000 and $1.5 million. So a seed fund focused on these really, really early stage consumer brands. So stay tuned for that. It doesn't help people today, but it's definitely, we always thought the 1 to 20 million was a really underserved market. I think that's $500,000 to $1 million is increasingly so as well.
Yeah, and I agree with everything that's been said. I mean, Karen, you at Circle Up, in the consumer world, we suffer from, or have over the long history of the consumer investing and deals, a developed VC community like in technology and like in healthcare. And that's started to come on strong over the last 5-ish years, but Circle Up, you guys were built, which is just genius, to serve some of that smaller market, at least initially. And so agree with Mira, it's tough, it's a slog. And if you don't have friends and family, try to find, as Mira had said, those people that know you, that will back you personally in a transaction. But we would always advise to try to hold off, sorry, Karen, to try to hold off with institutional money until as long as you can go, or as large as you can grow. That hopefully isn't too far out there, but it's after you get to 5, maybe 10 million in revenue, if you can get that far.
Oh, Don, just one piece of personal advice. So I actually started a company and we did a friends and family round. And like Karen said, it was really hard. What really helped us, and what I would advise entrepreneurs, is we got someone who is very well known in the CPG food space, a very well-known banker, to put in a sizable check. And once we got her on board, going out and raising, it's kind of like a hedge fund hotel. You get one hedge fund into a stock and everyone gets in. That helped us tremendously. And we also asked her to be in our deck as a board advisor. And I think that gave us a lot more credibility being so early. So I think, if entrepreneurs can find someone who's not only believes in them, but someone who has a reputable name, that could be hugely beneficial.
That's great advice, Mira. Finding that validator could be critical to launching a successful fundraise at this stage, or early stage of growth. 2 other quick thoughts for the founders, entrepreneurs to keep in mind. It's a 6 to 9 month process to raise capital, sometimes longer. So make sure you give yourself enough lead time and figure out alternative sources of working capital until you can bring in that outside money. And the second thought is that even if you're not asking for money, make friends with people who write checks and have them get to know you so they can track you and watch your growth so that when you're ready to do an ask, they're familiar with you and it's not a cold call. So let's turn to the question. We'll have time for, I think, a couple more topics before we go into Q&A. I want to move to the topic of valuation metrics and how the investor community is thinking about valuing companies in the new normal, how that might be different from pre-pandemic. Karen, any initial thoughts on that topic?
Yeah, we haven't seen a really material change as far as the valuation metric. We typically look at things on a sales multiple, so valuation divided by your LTM sales. If it is a more kind of subscription type model and you can really see the recurring revenue, we look at run rate, but that hasn't changed as much. I think the interesting dynamic is that we've seen multiples going up as far as the deals that get funded. But what we haven't seen is, I feel like there was a place, I'm not sure if it was pre-pandemic or maybe it was a little bit before that, but there was a place for companies to get funded at lower multiples, right? So it was like, you might have, like, you've got an all-star business, all-star management team, growing lights out. You're going to put a 8x multiple on that, right? That's a high multiple, but it's above the sector norm, but it deserves it because of X, Y, and Z. That's where the market's gone. I feel like we're not seeing the world where there are deals getting done at 2 to 3x or lower multiples. Like, those deals, it seems to me, just aren't really getting funded. And so exceptional companies are justifying and getting high multiples, but good, not great companies are just, from my standpoint, just having a hard time raising capital at all at any valuation.
Mira or Rodney, any thoughts on that topic?
Yeah, I mean, I would agree with Karen. We're seeing a bifurcation. Good companies that are exciting, tons of investor interest, and multiples have gone up about 20%, I would say, over the last year. And we're also seeing a premium being paid for companies with more D2C exposure over brick and mortar, although that might change. And like Karen said, companies that are in saturated markets, and there's 10 other energy drinks and we're the 11th, there's just less investor appetite. We're also seeing, and I guess I've said this before, we're seeing companies where investors can get confident about profitability 2 years from when they're going out to fundraise. Those companies getting even more of a premium than a company where crazy revenue trajectory, but pretty unsure about when we'll become profitable.
Yeah, and I think in and around the market, we've seen a couple things, and you had a question on this, Dawn, but right now there are more participants in the market from VC, early stage, all the way through later stage than there's ever been, which is positive for the markets. That probably, along with the amount of capital that's out there and strategic need for growth, are just fueling, as the panel here has talked about, high valuations and activity, especially around really good brands. And where we've seen VCs, private equity firms, and strategics historically, we're now seeing a larger, we see SPACs now, we're seeing a larger number of family offices participate. And then the tech-ish investors are moving in, it's like a Venn diagram, but that gap is closing. We're seeing more of those, and they're interested more in the food tech side of things, but still looking at other things. So that's great for the market. But what COVID has done, and what we've seen even prior to COVID, is the profitability profile of your business is coming into more play. And that's necessarily cycling earlier stage companies to a lower priority if there's a lot of other things going on and a lot of other activity out in the market. So what we've seen is a lot of investors looking at a lot of opportunities, and what's falling down are the smaller ones with less profitability, a little bit riskier, And so, Dawn, what you noted and aligned with what Mira had said as well, it's a slog out there in the small, looking for a small check. Just note it is, and just be ready to have to work pretty hard to find those earlier funds right now, especially in this crowded market. But there's a lot more people out there, a lot more later stage investors dipping down, and you should be able to find your opportunity and your capital at some point. It just may take a bit longer than you had imagined.
Thank you. So my last question, and then we'll pivot into the Q&A very quickly after this, is something that a few of you have mentioned about the D2C channel, e-commerce being very powerful during the pandemic, with brick and mortar grocery retail receding somewhat. Do you think that's a permanent trend? Do you see that shifting back? What are your thoughts about where that goes and how food entrepreneurs should think about developing their business model in response to that?
I think there's a big difference between D2C and Amazon, or Amazon and Walmart.com and Target.com and different places like that. I think you will continue to see shopping trend online. I think that is going to really, absent kind of those categories that Miro and I were talking about before, right? Like the ones that lend themselves to subscription models, coffee, pets, some nutritional supplements. I think we're going to continue to see people moving more and more towards marketplaces. The Thrive Markets, Groves, it doesn't have to be Amazon. But I feel like every founder hates it when I say this, by the way. I don't think every company has to have a robust direct-to-consumer business. I think in particular in the food and the beverage space, it's great to have some loyal customers. It's great to test and iterate and try new products and to introduce new products. But to think that it's going to be a third over, as far as a third D2C, a third Amazon, and a third retail over the longer period, I think we're just going to see things continue to aggregate more and more towards the Amazon and marketplace channels and away from the direct-to-consumer consumer channels.
I guess from our perspective, we're kind of guiding our companies that we don't know right now, right? We're just coming out of the pandemic. It's really early. We're hypothesizing. So I think the companies that we're feeling are the strongest are the ones that can pivot pretty quickly and have an omni-channel presence, so that over time, as we figure out how it's going to pan out, these companies are positioned to capitalize on whatever channel does end up, being the most robust for them. But like Karen said, I mean, we feel like shopping patterns have changed, and I don't know if they're going to go back to what they were pre-COVID. So we don't know, but I do think there's a shift. I just don't know how real it is, and I think we're going to see that over the next, I would say, 12 to 24 months.
I would echo some of the comments here. I'd also say, if you're the best you can be and you don't have any DTC exposure, you will get interest from people for sure. Siete Family Foods, Stripes Group is one example. If you're really good at DTC and you have an angle and that's what you'd like to do as an operating decision for your company, then that's great, and you can win that way as well. If you were doing both well, would that be better? Perhaps, but we haven't seen where there's an absolute need to get investor interest or to be successful as a business to have a DTC focus or a significant one.
Great. So we're going to jump into the Q&A now. We're not going to be able to hit all of them, and we're going to give quick answers to several. Those that we don't get a chance to answer on this Zoom, we'll follow up by email with responses. So we'll try to answer all the questions that have been posted. So I'd like to start with one that asks whether social and environmental impact metrics are playing a role today in food and natural products investing. Any one of you want to?
Sure, they are, and they're important. Unfortunately, what we see is while the momentum is moving in the right way, at least from our firm's humble perspective, where we see more of it, still we're rooted in a purely financial world, and so it's less impactful unless there's a way to connect it to direct finance and economics. But we are certainly, it is important, and we're moving in the right direction for sure.
Right.
Yeah,
Next.
I don't know that I've seen anything as far as like valuations getting higher or on the back of those attributes.
Right. Next question is about the tripwires in the due diligence process. When investors are looking under the hood and trying to assess whether they go forward, what tripwires or landmines have you seen that have caused deals to be knocked off track? Anything that is more pandemic specific, or are we still in the old normal in terms of what can run a deal off track here? Any thoughts on that?
I'm happy to jump in. I'd say they're the same as they've always been. There's nothing really that you can point to that happens as a trigger with a bunch of different companies. But I'd say, if you're looking for financing and you've waited quite a long time and you've stretched all your, and you haven't been paying your bills and you've got a lot of dated payables and the like, that would be an issue. But outside of something like that, it's all the normal type things. If you run your business well, it's aligned generally with GAAP. Of course, you can do cash, but you should be fine.
The one thing I might add to that is be upfront with your business in your deck or whatever you put in front of an investor for the first time. It's not a good use of your time. It's not a good use of the investor's time if you put in your deck that you have an LTV to CAC of 3x, but that LTV is based on revenue and it doesn't include cost of goods or shipping, or at least label it revenue LTV. I think there's a lot of times that entrepreneurs understandably will be trying to show themselves in a absolutely pristine, perfect light. And the minute you dig into it a little bit more, you realize that it's not, and that's okay. It's an early stage business. We wouldn't expect it to be perfect. We wouldn't expect it to be pristine. However, there are some metrics and some thresholds that are important that we would focus on, and trying to hide that or to give a 3-year LTV rather than a 1-year LTV, it just ends up not being a good use of your time, not being a good use of the investor's time, which time obviously is one of the most valuable things for all of us.
Yeah, the only thing I would add is if you're going to go out and raise $5 million in funding, you need to have your financials in really good shape and clean. I think what we've seen, we've sometimes taken on clients and helped them raise money before we've done their books, right? In reverse order. And if the financials and investors can't get comfortable, it doesn't matter how much they like the company, they're going to pull out of the deal. And so we've had certain deals where, investors just couldn't get comfortable around financials. Like Karen said, some of these companies have cash base. And so they say, come back to us once you have a good grasp. And I would say the second thing, which is very much similar to pre-pandemic, is gross margin and CPG. Everyone's all about the gross margin, understanding your gross margin and having a strong gross margin.
Great.
Yeah, and I'd add on what Mira had said. So there's two things that pop up in consumer, less on DTC side of things, but one is revenues, gross revenues versus net revenues. And we know all you entrepreneurs love gross revenues, and that's great. It's directionally fabulous number to work from. But what you actually sell at the end of the day is net revenues after all your discounts and allowances and everything. That is the number people will focus on, for good or for bad. You're not going to be able to change most investors. For really early stage, they will look at gross, but they'll start to say, what's your margin looking like and where's your gross margin going? And then 2, on gross margins, we see a lot of people, because it aligns with GAAP, putting their freight costs below gross margin and some other facility costs and the like, and trying to say that they're not in gross margin. I just say that's fine, and that aligns with GAAP in many instances, but don't be surprised when people come and say, well, your real gross margin isn't 40%, it's 22%, because you've got 10 to 20% in freight costs that, well, we really think are above the line and should be in your COGS. So I think, Mira, you had mentioned it. You've got to understand your gross margin and your profitability, because at the end of the day, somebody's going to take your financials, see what drops out at the end of the day, and put a value on that cash flow that comes out of it. And you've got to include everything in that at the end of the day.
So I know we've had a number of questions about some of the terminology we've been using, the financial terminology and valuation terminology. We will follow up with some information about that to all the participants so we can clarify those questions. All the questions that have been posed will be answered by email. Just give us a few days to do that. And we very much appreciate your participation. And I want to thank our panelists for doing a fantastic job. We'll be providing their contact information if you want to reach out to them individually for support. And I want to thank our Naturally Bay Area team, Lizzie and Monique, who have been behind the scenes making all the magic happen here. So thank you for participating, and we'll look forward to talking to you again soon. Be well, everyone.